Hello everyone, welcome to Edupedia World. I am C. Radhika Singhal. In the last class, we started regarding nature and significance of financial management. There we started what is financial management, why it is so important. So if you remember, in the last class we started regarding economic value added, where we used cost of capital to compute it. So in today's class we are going to study what do we mean by cost of capital and how do we compute it. So let's take an example. I think you all have seen such an extract of balance sheet, right? Equity share capital, 12% preference share capital, debentures, all these are the components of capital. Do you know why they have invested into the business? Suppose if you are a debenture holder, why you will invest into the business? You expect some return over and above your capital. So let's talking about debenture holder first. 10% debenture holders. So 10% signifies the interest rate. A 10% debenture holder, how much the debenture holder will expect from the company? What will be his expectation from the company? Just as interest portion, right? So in this case, in our example, the debenture holder will expect rupees 10 from the company. Whether the debenture holder have any other expectation apart from the interest amount? No. Their expectation is fixed, that is rupees 10. In a similar way, a 12% preference share capital, they have a preference dividend right, but their dividend is fixed. We know that their expectation is 12 rupees. Now let's talk about equity share capital. What do you think? How much will be their expectation? Is their expectation is fixed for every year? No. They are the residual owners of the company. So by residual owners, that is only the surplus left after paying off the interest to the debentures and after paying the dividend to the preference share capital. That means they are the riskiest one. So what is the golden rule of financial management? More risk, more return. So the equity share capital will definitely expect more return than the preference share capital and debenture holder. So if the expectation of the preference share capital is rupees 12, so obviously the expectation of the equity share capital holder will be more than rupees 12. Let's say the expectation of the equity share capital is rupees 15. So the company has to at least generate funds, that is rupees 37, in order to meet the expectations of all these finances, right? So the company has to at least invest 300 rupees in such a way that they can generate a return of rupees 37 so as to meet their expectation. Why do company need to meet their expectation? See, if the company is not going to meet their expectation, why they will invest into the company? So this 37 is the minimum cost that the company has to bear, or the company has to generate this much return so as to bear the cost of the fund holders. Otherwise they are not going to invest into the business. So this much return is the minimum return that you have to give to the financiers for providing you capital. This 37 is the cost of capital for you. So what do you understand by cost of capital? Cost of capital is basically the required rate of return, right? For 300 you have to generate 37 that a firm must earn for what? To cover the cost of generating fund in the marketplace. Clear? So when I am saying required rate of return, that means we compute cost in percentage. In FM, we just denote this cost by K. Now in the previous example, you have noted each source of finance, they have different expectation from the company. Debenture holders have rupees 10, preference 12, equity shareholder rupees 15. So each source of finance has a different expectation. So we compute the cost of specific sources. So let's say for cost of debt, that will be denoted as KD because we are going to compute the cost of debt separately. Similarly, for preference share, it's KP. For equity share, it's KE. These are not the only sources of finance. Do you know below the capital there's a reserve and surplus? Who is the owner of that reserve and surplus? So that is the residual surplus which you have generated in your business and retained in the business. But the equity shareholder has the actual right over that reserve and surplus. Correct? So there is some cost, because instead of declaring that amount as dividend, you have retained that amount into the business, though the equity share has the right over it. So there is also a cost of retained earnings, and that we denote as KRE. So we are going to discuss each cost and how we compute it. Let's start discussing with cost of debt first. So I'm taking an example. There's case 1 and case 2. You can say as company 1 and company 2. So in case 1, the company has not taken any debentures. Both are having 3 lakh rupees as their total capital. But in case 1, there is no debentures, and in case 2, there is 1 lakh rupees debentures. So if I prepare the P&L for the company in case 1 and case 2, let's talk about case 1 first. In case 1, let's say the profit is 1 lakh rupees. In case 1, there is no debentures. So there will be no interest cost. Zero interest cost. So the earning before tax will remain rupees 1 lakh. Let's say the company is in a tax bracket of 40%. So 40,000 will be the tax amount. And the earning available after tax is 60,000 rupees. In case 2, since there is 1 lakh rupees as debentures, there is an interest cost on that 1 lakh. So for 10% debentures, there is an interest cost of 10,000. So from 1 lakh, they have to first pay interest portion. Interest portion is an expense. It's a P&L hit. It's not an appropriation. So we are going to reduce the interest before giving taxation. So interest before tax will become 90,000. Since the company is in a tax bracket of 40%, the earning available after tax is 54,000. So if you observe, though the interest amount is 10,000, the difference between earning after tax in case 1 and in case 2 is only 6,000. So the company has expensed 10,000 extra. However, on that 10,000, the company has saved rupees 4,000. So this 4,000 is the tax saving which the company, why that tax saving company has received? Because of the interest amount. So what is the net expense which has actually hit the company? 6,000. So if you could say that these 10% debentures has actually cost the company how much? 6,000. In other words, how we computed the 6,000 amount? 10,000 the interest amount, and we reduce the tax portion over it. So we could say interest expense less interest expense into tax rate. So if I take this interest expense as common, this will become 1 minus tax rate. Let's consider interest expense is equal to I. If we denote interest expense as I, it will become I into 1 minus T. So in our example, because I have to compute return, right, required rate of return in percentage term, 6,000 rupees is in amount rupees. So to convert this amount, in percentage, we will divide 6,000 by 1 lakh and multiply that by 100. So 6% is the actual cost or the cost of debt for raising 10% debentures of rupees 1 lakh. Let's understand it better with the help of one more example. The company has debentures, 15% debentures of rupees 4 lakh. So the interest expense will be 60,000. Tax is 40%, so the net expense will be 36,000. In order to compute the cost of debt, 36,000 is the expense on rupees 4 lakh. So for 100 it is 9%. So for 15% debentures of rupees 4 lakh, the cost of debt to the company is 9%. And this is how we compute the cost of debt. So cost of debt is the principal amount. So this is how we computed cost of debt. So cost of debt is interest, the net of interest expense divided by the issue cost. I have written net proceeds, so I'm going to explain further why I have written net proceeds in denominator. And I've also written irredeemable, that we are going to discuss that what type of debt it is. Let's do one more example. For example, X Limited is issuing rupees 1 lakh debentures of rupees 100 each, carrying a coupon rate of 10%. Coupon rate means interest rate. Generally, in a layman language, we call it as interest rate. In our technical language, it is called as coupon rate. So, they both mean the same. Coupon rate means the interest rate. The company is in a tax bracket of 30%. So, how will you compute the cost of debt? 1 lakh debentures of 100 each. So, here we get the number of debentures. Multiply by the face value of share. Note one thing. We always compute the interest rate over the face value of the security. Even if the shares or the security is issued at discount or are issued at premium, the interest is always paid at the face value of the security. So the interest portion in this case will be 10 lakh. 30% is the tax amount. So 7 lakh is the net expense to the company over rupees 100 lakh. So the cost of debt to the company is 7%. Presume whatever we did in the last example, if the debentures are issued at a discount of 5%. So if the debentures are issued at a discount of 5%, the company has received how much rupees? 95 lakh rupees. Now what do you think? What we are going to take as denominator? 100 lakh or 95 lakh? See, from what amount you are going to meet the expectation of the financer. So for debenture holder, from what amount will you generate funds? Is it 100 lakh or is it 95 lakh? 95 lakh. Because obviously you will generate the funds or you will generate the return or you will bear the expense from 95 lakh rupees only. No? Though you have to pay the interest on 100 lakh rupees. But from what source of finance or from how much funds you are going to meet that expense? From 95 lakh. Because that is what you have actually received. So in this case, to compute the cost of debt, our denominator will be 95 lakh. So 7 lakh divided by 95 lakh. The cost of debt for the company is 7.37% in this case. One more example. If they are issued at a premium of 10%. So applying the same logic, so instead of 100, the company has now received 110 lakh. So from what amount they have to meet the expectation? 110, because that is the funds they have actually received. But there is one more information, that is a flotation cost of 4% of 400 basis point. So basis point is like 100 basis point is equals to 1%. So 400 basis point is equals to 4%. And flotation cost is the issue cost. If you issue some new security, the cost that you incurred for raising that fund is called as flotation cost. So to compute, we have to first compute the net proceeds, because the denominator will show the actual funds that the company has received. Because from those funds only, the company will meet the expectation of the debenture holder. So what is the net proceeds in this case? That will be 1 lakh into 110%. So that is 110 lakh. And since you have to meet the flotation cost also of 110, you will reduce 4%. So multiply by 96%. So in this case, interest expense is same, that is 7 lakh rupees. Because I just told you, we compute the interest amount on the face value of the security. So 7 lakh divided by the net proceeds, that gives a cost of debt of 6.11%. That's why in the previous slide, I have written net proceeds in the denominator. So just note, we have noted these things, that we always take the denominator as net proceeds. But in all these examples, I have just shown when the security is just issued. If the security is already there in the market, we will take market value as a denominator. And if market value is not available, we will take book value. So the first preference is to the net proceeds, the second to the market value, and third to the book value of the security. Okay, so in the previous slide I have written cost of irredeemable debt. Now I'm going to explain that what is irredeemable. Debts are of two types. One is irredeemable debt, one is redeemable debt. You all are aware of, I think, these terms. Irredeemable, which is not to be redeemed, that is the principal amount which not to be paid back during the lifespan of the company. Unredeemable, that they are issued with a time period. For example, if you are issuing a debentures for 5 years, so after 5 years, you have to repay back the principal amount of the debentures to the debenture holder. So, in case of whatever example that we did now, all those examples are examples of irredeemable debt. Because what is the actual expense? The interest portion only. What if there is an extra expense that you have to bear on redeemable debt? We will explain this. I will just explain you this with the help of an example for better clarity. Let's say 10% debentures of rupees 100 which are redeemable at a premium of 10% after 5 years. So there is one extra information that you get that within your tenure it is to be redeemed, that is 5 years. And what will be the redeemable value? So for rupees 100, you have to pay rupees 110 after 5 years. So just think, what is the actual expense that the company has to pay? Interest expense for every 5 years, 10 rupees first year, 10 rupees second year, and so on for 10 rupees for 5 years. In the 5th year, the company has to pay rupees 110. But how much amount the company has actually received? 100 rupees. So for 100, they have to pay 110 after 5 years. So there is also a loss to the company in redemption, right? So since the time span is 5 years, if I divide this loss or I can allocate this cost every year, what will be the cost? 10 divided by 5, that is 2 rupees every year. So if you think, interest is the only expense that the company has to bear. There's an additional loss that the company has to bear on redemption, correct? So if we compute the total cost to the company, that will be interest, which is to be paid for 5 years. So 1 year expense will be what? 10 rupees interest amount and 2 rupees, that is 10 rupees the premium amount that the company has to pay on redemption, divide by 5 since we allocate that expense every year. So we could say that the total loss to the company is 10 into 1.040, that is we compute the interest amount net of expense plus 110, which is the redemption value, less the net proceeds that the company has received. Because so what 110 minus 100 represents? The actual loss to the company in redemption. Divide by 5 to compute a year expense, because this is the expense that the company has to pay in 5th year. So for every year the company also has to bear a total expense of rupees 2. Now tax, that is only deducted in interest because interest is only a tax deductible expense. The premium that you pay on redemption is not a P&L expense, so there is no tax saving over it. And for denominator, we take the average of the redemption value and the net proceeds. And this is what the formula in the books do. So cost of redeemable debt is I into 1 minus T, so 10 into 1.40 plus the redemption value less the net proceeds divided by the term for which the debentures are issued divided by the average of net proceeds and redemption value. This is how we compute the cost of debt for a redeemable debt. So there is one more example, try to solve it. Z Limited is issuing rupees 100 debentures carrying a coupon rate of 12%. Clear coupon rate now? The debentures are redeemable after 10 years. The company is in a tax bracket of 40%. I've just given an information that the debentures are redeemable after 10 years. So by this we mean that whatever is the issue cost, that is the face value of the share, and we are going to redeem it at the face value only. So if we compute the total expense to the company, one is the interest amount, 12 rupees, net of expense, plus is there any other loss to the company in redemption? No. They have issued the debentures for 100 and they have to pay back 100 rupees on redemption. So there is no other loss. So the cost of the debt in this case will be 7.20%. One more example. Now the debts are issued at a discount of 10%. So instead of 100, you have received rupees 90. But you have to redeem that amount 100 only. So though you have issued a 90, you have to redeem rupees 100. So now there is a loss of 10. So interest expense plus that loss. So the later one portion that we took in for computing the cost of debt for a redeemable debt is the loss between the redemption value and the issue cost, the issue price, divided by 10, that is the term for which the debentures are issued, divided by the average of the redemption value and net proceeds. So the cost to the debt in this case will be 8.63%. Now there's one more information. Remember I have told you that we take net proceeds, market value, and the last the book value. In this case, the debentures are already issued and there's a market value of rupees 120. So what is the cost of debt now? Is it like today the value of the debenture is 120. You have issued a debentures of rupees 100 and you have to redeem rupees 100. You have a profit? No. So there will be no change. Remember what I told you. We compute the actual loss to the company. The company has issued rupees 100. The company has to pay rupees 100. So irrespective what exactly is the market value of the share, the company do not have any loss in the redemption value and the issue price. So even if the market value is provided, what we are taking in the numerator is the expense to the company, and there is no expense. So the market value of the share does not affect. So there will be no change. The cost of debt will remain same as we computed in our previous two examples. So this is all about cost of debt. In the next class, we are going to study cost of preference share, equity, and retained earnings. Thank you everyone. Keep smiling.